Welcome to this session on employee benefits, IAS 19. We'll start with short-term employee benefits, which are benefits other than terminal benefits. These are expected to be settled wholly before 12 months after the end of the annual reporting period in which the employees render the related service. Examples of short-term employee benefits include salaries, wages, paid annual leave, paid sick leave, profit sharing, and bonuses. Also included are non-monetary benefits such as medical care for those whose companies pay for their medical care, housing for those whose companies provide housing and cars, as well as free or subsidized goods or services. The short-term benefits are recognized as a liability and at an expense when the employee has rendered the services during a particular accounting period. These are accrued and are not discounted since they are expected to be paid within 12 months. Also included are short-term paid absences, which are divided into two. These are accumulating paid absences, which are carried forward in a period if they've not been fully utilized by the employee. Examples include holiday pay for those companies whose employees are entitled to carry forward some days out of their leave days which have not been utilized in a particular year to the following year. Those days which are carried forward need to be recognized through an accrual since they've rendered the service in that particular year and they've not utilized those days. So an accrual is included in the financial statements at the end of the year. Then we have also the non-accumulating paid absences. These you only utilize them in the period in which you take the leave, meaning if the leave has not been utilized in that particular year, it cannot be carried forward to the following year. Examples include maternity leave. We now look at an example of accumulating paid absences. In this question, we have an entity whose employees are entitled to 20 days paid leave each year. The entitlements accrue evenly over the year, and unused leave may be carried forward for 1 year. The entity allows the employees to carry forward 4 days per employee as unused pay days to the following year. The entity has 2,200 salaried employees, and approximately 6% of these employees live in a year without taking their entitlement, and they are not entitled to any cash when they leave in respect of their holiday pay. There are 255 working days in the year, and the total annual salary costs is 42 million. the question requires us to account for the leave entitlement carried forward at the end of the financial year. Since we have this annual salary cost for the employees, we divide that, we multiply that by the employees who are left, which is 94% of employees. Then we multiply that by the 4 days entitlement, divide that by the total working days in a year, to give us the expense we need to recognize at the end of December 20X4. Then we accrue for this in the statement of financial position for the year. So the cost to recognize in the P&L is 619,294, which we are going to accrue in the statement of financial position as well. Next, we move to profit sharing and bonus plans. An entity recognizes the expected cost of profit sharing and bonus payments when and only when both of these following conditions are met. The condition is that the entity should have a present legal or constructive obligation to make such payments as a result of past events. You take note that this comes from IS 37 provisions. The second condition is that a reliable estimate of the obligation can be made. The present obligation exists when and only when the entity has no realistic expectation but to make the payments. All these being borrowed from IS 37 provisions. We now move to post-employment benefits, which are benefits employees for employees which are post-employment benefits employees which are payable after the completion of employment. These are divided into two, namely defined contribution plan and defined benefit plan. We'll start with a defined benefit plan. To account for this, you need to be aware of their differences, since they are both accounted for differently. But one key point to note is that a pension plan will normally be held in a form of a trust separate from the sponsoring employer. Although the director of the sponsoring entity may also be trustees for the pension plan, the sponsoring company and the pension plan are kept as separate legal entities. Not kept, but they are separate legal entities. And they are therefore accounted for separately. To go to the defined pension plan, this is a post-employment benefit plan under which an entity pays fixed contribution into a separate entity. The sponsor will have no legal or constructive obligation to pay further contribution if the funds held in this separate entity are not sufficient to pay all employee benefits relating to the employee services in the current and prior periods. So, the obligation of the sponsoring entity ends with the contributions which are made in the plan. If the plan does not have sufficient assets to pay the employees, the problem is for the employee to sort out. The employee cannot go back to the employer to demand for further payments. So this is quite easy to account for. The sponsoring employee will recognize an expense in the income statement, which will be disclosed in the notes and in the statement of financial position only to the extent that it has not been paid. If the payment has been made, then there will be nothing to show in the income statement. There will be nothing to show in the statement of financial position. Let's look at an example. We have an example of Mouse, a PLC, which agrees to contribute 5% of employees' total remuneration into a post-employment plan each year. In the year ended 31st December 2009, the company paid total salaries of 10.5 million. A bonus of 3 million based on the income for the period was paid. The company had paid 510,000 into the plan by 31st December 2009. We are required to calculate the total profits or loss expense for post-employment benefits for the year and the accrual which will appear in the statement of financial position, if any. The 5% contribution is based on the total remuneration. So we are going to add the 10.5 million to the 3 million to give us 13.5 million. We get 5% of that, which is 675,000 as the expense which should be recognized in the P&L this year. Out of this 675, the entity has only paid 510 into the plan, so they have to show an accrual of the difference. So 675 minus 510, an accrual of 165 will be shown in the statement of financial position. So this one is quite straightforward. We now move to the defined benefit plan.